You may be wondering why the majority of cryptocurrency investors lose money, while some seem to go through market cycles without disappearing. Many people believe that success in crypto depends on luck, perfect timing, or secret information. In reality, results are mainly driven by psychological mechanisms and repeated behavioral patterns. In this video, I will explain why so many people fail and how some manage to stay disciplined over the long term. We will analyze common mistakes that appear in every market cycle and see how to avoid them. The goal is not to promise quick profits, but to understand what destroys the majority of portfolios. Whether you are a beginner or have already experienced losses, this video can help you step back and gain perspective. Understanding these principles will allow you to approach the markets with more clarity and fewer emotions. Around 90% of people who invest in this space experience significant losses at some point. This does not mean that crypto is a trap, but rather that many people enter the market without proper preparation. Bull and bear cycles are natural. Prices can rise very quickly and then correct sharply. Those who do not understand this dynamic often react under the influence of fear or euphoria. Losses are therefore not caused only by price movements, but mainly by decisions made under pressure. Experienced investors know that markets test patience. They accept that difficult phases are part of the process and focus first on preserving their capital rather than multiplying risky bets. The first mistake is blindly following the crowd. When everyone talks about a cryptocurrency and the media becomes excited, many people buy without analysis. This reaction is often driven by the fear of missing out. Historically, these massive buying phases occur when prices are already high. On the contrary, when the market is calm or negative, few people are interested. Patient investors understand that the best opportunities often appear when enthusiasm has disappeared. Doing your own research takes time and effort. It involves analyzing fundamentals, the real utility of a project, and its positioning. Those who avoid herd mentality sometimes accept being contrarian, but this approach significantly reduces impulsive decisions. The second major mistake is the absence of an exit plan. Many people buy a cryptocurrency without knowing when to sell or take profits. As long as the market goes up, this lack of planning seems harmless. The problem appears during corrections. Without a clear strategy, fear takes over. Some refuse to sell, hoping for a quick recovery, while others panic and sell at the worst possible moment. These emotional reactions often amplify losses. An exit plan does not guarantee perfect results, but it provides structure. It helps reduce the impact of emotions and allows for consistent decision-making. Disciplined investors know in advance under which conditions they will act, which limits stress-driven decisions. Leverage is often misunderstood. It increases market exposure, but it also amplifies losses. A relatively small price movement can be enough to liquidate a position when leverage is high. Many beginner traders are attracted by the possibility of quick gains. They underestimate how fast a position can be automatically closed. Leverage turns normal market fluctuations into significant losses. Prudent investors rarely use leverage, if at all. They prioritize risk management and capital preservation. Understanding the effects of leverage is essential to avoid irreversible mistakes. Bull markets attract many low-quality projects. Unrealistic promises, anonymous teams, and the absence of a functional product are common warning signs. Many investors ignore these signals in the hope of fast profits. Another common mistake is the lack of diversification. Putting all your capital into a single asset exposes you to extreme volatility. Even solid projects can experience major drawdowns. Diversification does not mean investing randomly, but spreading risk across different categories. This approach helps limit the impact of failure and stabilize a portfolio over the long term. Fear and greed strongly influence investment decisions. When prices rise, the temptation to take excessive risks increases. During downturns, fear pushes investors to sell hastily. Disciplined investors follow a written plan and accept volatility. Security is also an often overlooked aspect. Leaving assets on centralized platforms exposes them to external risks. Understanding the importance of emotional management and security helps avoid preventable losses. These factors are often underestimated, yet they play a key role in long-term survival. There is no miracle solution. Success in cryptocurrencies relies on patience, discipline, and an understanding of risk. Investors who approach this market as a marathon rather than a sprint are better prepared. Responsible strategies are based on risk management and consistency. Investing gradually helps reduce the impact of timing and avoids impulsive decisions. This approach brings greater stability. Setting clear rules helps maintain consistency during market movements. Patient investors favor consistency over the pursuit of quick gains. These principles may seem simple, but they require discipline. Those who apply them consistently are better prepared for difficult market phases. Market downturns are part of the process and sometimes offer opportunities for those who are prepared. Applying these principles helps avoid common mistakes and build a calmer approach. The goal is not to predict every market move, but to remain consistent and disciplined. This mindset increases the chances of navigating market cycles without suffering irreversible losses.